I had an interesting phone call 2 weeks ago from a client of mine because this client was upset with me about something. And so we had a phone conversation, and I want to share that phone conversation with you because I think it can impact your income, your net worth, your portfolio. I think it can help it and actually also help you reflect on what's going on with your own investments. And then I want to show you two very interesting price charts that you absolutely have to take notice to. So this conversation happened a couple weeks ago, and it was around a mistake. I put so much money into GDX, and I said, you know what? I actually want to pull back a little bit. I think we put too much money into GDX. I want to lower that amount, and it's because I saw what GDX did the 3 days after Ben Bernanke said there would be no pullback in money printing, and you'd think GDX would absolutely take off from there, and it did the first day, but then the next 3 days after that, it fell in price more than the 10% that GDX kind of moved up the day of the announcement. And that concerned me. And so I said, you know what, maybe I made a mistake, or maybe new information has changed my opinion. You can call it whatever you want. In politics, they'd probably call it a mistake. In investing, you'd probably say the facts have changed, so I changed my approach. But it doesn't matter how you frame it. And this person was really upset with me. And the question that I just want to share with you this week, or the thought I want to share with you this week is it okay for you to make a mistake? Or is it okay for you to adjust your approach or opinion when you have new facts presented to you? And you can choose however you want to frame it. So to this person, this client, it was framed as a mistake, not as new information coming in and making an adjustment. And my question to you is it okay for you to make a mistake? And for this client, it wasn't okay for me to adjust my opinion or to say, hey, maybe I made a mistake, and with this new information, I'm changing it. And this reminds me of a roommate I had when I very first moved to San Francisco. He had his PhD from MIT in basically nanotechnology, which back in the late 90s, no one was really throwing that word around. And I said to him, his name is Raj, his name was and is Raj. I said, so what'd you get with your PhD? And mind you, we were in our mid-20s, and this guy had a PhD from MIT already. I said, so what'd you get from it? And he said, well, I'm allowed to say I don't know. And not just about nanotechnology or any technology, but really about anything in the world. I now feel that it's okay that I don't know everything. And in fact, I can say I don't know. And I think that's interesting that sometimes it takes a top PhD type degree to give people the freedom to be like, you know what, I don't know. I don't know what's going to happen. Let's look at what is happening right now, and let's try to figure out what might happen. And so for you, I just want you to ask yourself, how okay is it for you to not know? Or how okay is it for you to say, you know what, maybe I made a mistake. Maybe I should not have bought XYZ or ABC or 123. I mean, after all, isn't that why we have a stop loss? In case we buy something that moves against us? Though I would not say an investment that moves against you is a mistake. I say that is a very prudent step to have in a strategy. So I want to talk about or look at something that happened back in 2007 and something that's happening today. So let's look at this screenshot right here. If you look at this, you see two price charts, one on the top and one on the bottom, and then you see two vertical red lines. So just put your attention with the price chart at the top. That is a price chart of the percentage of stocks in the S&P 500 that are above their 200-day moving average. And as you can see on the screen here, the percentage of stocks on the S&P 500 above their 200-day moving average was about 85% in February of 2007. And then it just kept falling. Fewer and fewer stocks as a percentage in the S&P 500 were above their 200-day moving average. Fewer and fewer and fewer and fewer until October of 2007. They were down to about 50%. So in October of 2007, only about 50% of stocks in the S&P 500 were above their 200-day moving average. Now, if you look below to the S&P 500, you'll see that there was a bit of this convergence going on. Even though the percentage of stocks above the 200-day moving average were getting to be fewer and fewer and fewer in 2007, the stock market from February 2007 to mid-October of 2007 kept going up. And so there's actually kind of this is specifically a convergence, but I like to use the word divergent. There was a divergence between how many stocks were above their 200-day moving average and the direction the S&P was going up. So this means that the S&P was going up over that exact same time period with fewer and fewer stocks moving up. And October 2007 for the S&P was its high up until, 4 months ago? And from October 2007 to March of 2009, the S&P 500 fell 58%. And let's just round that to 60%, which is almost 2/3. It almost fell 2/3 of itself in about 18 months. And there was this divergence going on between the amount of stocks above 200 days and the direction the S&P was going. I bring this up because let's fast forward to today, or to 2013. Now look at this. Look at the top price chart. That is the percentage of stocks in the S&P 500 above their 200-day moving average. And as you can see, in January of 2013, there was about 82% of S&P stocks above their 200-day moving average. And throughout the year of 2013, moving into where we are now there's about, let's just call it 50%, even though it's 49.48. Let's just call it today. Now there's only about 50% of stocks above their 200-day moving average in the S&P 500. So it's fallen from about 82% to 50%. So there's fewer and fewer stocks moving up or above their 200-day moving average on the S&P 500. Now look at the chart below, which is the S&P 500. From that peak at the end of January, where fewer and fewer stocks are above their 200-day moving average. Notice how the S&P 500 is kind of diverging and it's continuing to go up all the way to the middle of September. Now, I am at no means saying that we're going to have a 58% correction, but what I am saying is the longer that these two charts diverge or move in the opposite direction, the higher the probability, the higher the chance is that the S&P will either have to fall and correct, or those 50% of stocks that are below their 200-day are going to have to start moving up. Now, the one thing I do know for sure is the average profit margin is at extreme highs for stocks on the S&P 500. In fact, it's about 70% above its historic average. And the most mean reverting number on this planet is profit margin, because when the profit margins get too high or get way above their historic mean, there's only one direction left, and that is to go back down to its mean, its average. So here we sit today with the percentage of stocks in the S&P 500 above its 200-day moving average falling this year, even though the stock market over the exact same time period is up about 18%. It's something to be aware of. It's something to make note of. It's something to let you know that the internals right now are actually not getting better. Yes, the S&P has gone up. Yes, it's up 18%-ish this year, but it's not on the back of deep value investing. It's really not 100%, but there's a significant part of the move up on the S&P because a lot of the money printing around the world has moved into this index, and it's something to make note. Now, my final thought of the weekend, most of you will be watching or listening this on the weekend, is what if the Fed has already lost control of the 10-year Treasury? And the reason I bring this up is because if you follow that big arrow right here, this price chart you see here is the yield on the 10-year U.S. Treasury. And what's so important about this chart is this little squiggly line right here at the very end or the very beginning, depending on how it's actually the very most recent data. And the yield is moving back up. Now the yield moved down when Bernanke came out and said, I'm just going to keep printing money. I'm just going to keep printing money because, and here's the thing. Now, this could be a conspiracy theory. I think one of the reasons why he said he's going to continue printing money is because he saw that the 10-year Treasury yield was about to break above 3%. And I think that really scared him. His thinking must be, this economy cannot survive with a 10-year Treasury above 3%. So he said, hey, we're going to continue printing tens of billions and hundreds of billions and trillions of dollars each year. And that moved this yield down a little bit, right, from 2.9% to about 2.6%. But it looks like it's bottoming right here. In fact, that is a bottoming formation. So it'll be very interesting to watch what happens to the yield on the 10-year Treasury over the next month or two, because if this moves back up, and Bernanke said we're going to keep printing money, that possibly means that the market, which is gigantic, and the government does not control the 10-year Treasury, says, no, we want higher yields. And that means a potential downward pressure on the economy, because that will mean mortgage rates will go up. That means borrowing rates will go up. Two things that a barely growing economy probably does not want to see. But as you know, we have strategies that are adapting and looking at the markets. They're not looking at the news. They're not looking at opinions. They're not looking at emotions. They're looking at what the markets and the sectors and the stocks are actually doing and positioning your money to make sure you're on the right side. And if you do not have a strategy that has been back tested and that has worked through all these past decades, like the last 11 decades, then you're going to want to look at the strategies you're using. I thank you guys so much. We're actually having Bowen's birthday party this weekend. He turned a year older last weekend, and we're having his birthday party this weekend, so we're very excited about that. My mom and dad are coming to town, which I always like because I don't see them as much as I used to. And we're having a bird show. It's actually a parrot show for Bowen. He absolutely loves being animals. Every day he's a different animal. Today he's a peregrine falcon, and we're only allowed to call him Perry or Falky. While my daughter, who's 2.5 years old, she pretends to be a 5-year-old boy. When we ask her what she wants to be, she's like, Dad, I want a 5-year-old boy. It's just a delight to be a dad to these just beautiful kids. You guys take care. You have a great weekend. This coming Tuesday is an in-person monthly gathering. We've only had, I believe, only one other this year, so that is happening this Tuesday, 6:30, right here in Silicon Valley. Be there. It's a great time to connect with others and connect with me, and that's this Tuesday, 6:30. Thanks so much, everyone. You take care.